Welcome to the Snowbird's Expat Radio podcast, powered by the Snowbird US Day Tracker app. I'm your host, Gerry Scott, and my goal is to give you answers to your cross-border questions, to ease the stress of a cross-border move or extended trip, and to keep you up to date on all you need to know with cross-border rules and regulations. Now let's get on with the show. Hello, everybody. Welcome to the Snowbird Expat Radio podcast. Today we have Alexey on the podcast, and I'll get Alexey to go into his full pronunciation of his last name. And we were just having a little fun before we went on air because we've got Alexey in Tampa, we got this big kahuna in Maui, and we got the poor producer in somewhere in Toronto in 20 feet of snow or how much snow they had. He was complaining about his bike ride, and Alexey said he didn't have a problem with snow, and of course I had to add it. So Alexey, welcome to the podcast, and tell us a little bit more about yourself, your firm, and the team that you've put together here.
Yeah, so the name is Alexey Manasuev, and thank you for inviting. I appreciate to be here, Jay. It's great to have ability to participate in the podcast. You're doing a great job for snowbirds and a lot of US expats who have a lot of different implications financially and tax-wise. I'm a US tax attorney. I'm admitted in New York and DC, and I'm also principal with US Tax IQ. It's a tax firm where we handle all aspects of US tax compliance and consulting and planning. We focus on US international tax and cross-border taxes. And we see our purpose in empowering people to live and work worry-free. And so we don't use scare tactics to get any clients to work with us. And by the same token, we see our job done well when people can sleep well while we are taking care of their taxes. So that's the idea. And after all, cross-border taxes shouldn't be so taxing.
Well, you say that, but you're being very humble because this is a very complicated arena. And I tell people, this is not one of those do-it-yourself podcasts where Alexey's going to educate you and then you can go to town and make a mess. This is really about connecting professionals with people that need help. So today we've got 10 questions. And if we can, Alexey, we're going to try and jump on. We'll get the Canadian side of things first. American in Canada, and then you can talk about that Canadian on the U.S. side as best as we can. So we're going to get going with the questions, and at the end of the show, the way that they put these podcasts together now, Ideal Decanter does a great job posting them, providing you with a great package so you can actually connect with people that download the Snowbird US Day Tracker app or the Canada Physical Presence Tracker app. So like I say, it's about connecting people that need help. Okay. Question number 1. Do U.S. citizens living in Canada need to file U.S. tax returns?
The short answer is yes. But I just want to say, this is a simple question and supposedly a simple answer. And yet you cannot imagine how many U.S. expats get in trouble for not filing their tax returns. And this is especially true for U.S. expats who live in Canada or other high tax jurisdictions. Because one of the misconceptions is, well, I have higher taxes. What do I need to do with U.S. tax return when it's all zeros in the end anyway? But the United States, as you know, and as our listeners are aware, taxes its residents and citizens on a worldwide basis. So that's where there is a big discrepancy between countries that have residency-based taxation, and that's one of the misconceptions thus. But that means that no matter where you live, as a U.S. citizen, no matter what sources of income you have, you are required to file U.S. tax return, and you have certain tax filing and reporting obligations.
We know that Americans have to file tax returns when they're in Canada because of the citizenship concerns. What about a Canadian that is living in the United States? We know they have to file U.S. tax returns. Do they have to file Canadian tax returns?
Well, that depends on whether they have Canadian source income and whether they still are treated as Canadian residents, right? Because depending on their facts and how much time they spend in the U.S., they may still be treated as Canadian residents and non-residents of U.S. And let's suppose the Canadian spends 121 days in the US every calendar year. They would not meet substantial presence test, and as such, they would not necessarily have filing requirement. They wouldn't be treated as US tax residents. By the same token, if they spend not more than 182 days in the US in any given year, they can claim closer connection and still be treated US non-residents and would continue to be treated as Canadian residents. So they would be still taxed in Canada and may have some taxable obligations in the US, but it all depends on their facts and what income they receive from US sources. And then there is the third scenario, and that's one that is sometimes missed. And that is when you spend more than 182 days or 183 days or more in the US, you can still be treated as a non-resident for US tax purposes and remain a Canadian tax resident by invoking treaty tiebreaker provisions. So Canada and the US have income tax treaty, and Article 4 has residency tiebreaker provisions that can allow taxpayers to rely on them to claim their home in Canada while spending substantial time in the United States. They also have, and that's very important, certain international information return filing obligations in that case, and that is missed a lot of times. Let's say a Canadian who owns a company in Canada spends 200 days in the US, they have an investor visa, E2 visa, and they invoke treaty provisions, so they're treated as US non-resident, and you think, well, they only need to report US source income and file non-resident tax return in the US, along with Form 8833 to report treaty-based position. But they fail to file Form 5471 to report their Canadian corporation. And that's one of the examples where you need to be careful as to maintaining certain presence in the US and understanding your tax obligations and reporting obligations based on your residency status and based on various other tax considerations that I just mentioned, because penalties are draconian.
Well, we were just the last couple of days, my wife and I were filling out our 8840s. You know, we've got the app that allows you to track the days over 3 years, and it also allows a 12-month rolling calendar. So we'll get into that at a further date. But the 8840, I tell people, take your time. It's not overly difficult because the answers are Canada, 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 Canada. But this is where this app, Snowbird US Day Tracker app, really helps people gather the information and stay compliant. So we just had to do that the other day, and I'm assuming if it's 8840, there's 839 other forms between Canada and the United States. I'm just trying to be funny here, but here's another question for you. Are my Canadian retirement accounts treated the same as U.S. retirement accounts for tax purposes?
Technically, yes, for certain purposes, but not for all purposes. And both U.S. retirement plans and Canadian retirement plans would be treated as qualified retirement arrangements, such as RRSP, for example, right? But the tax treatment would depend on several factors. One, and we'll probably get to that question later, but so the answer is yes, with certain exceptions, and the tax treatment depends on the contribution to the plan, and then during the time when the investment grows, and at the time of distribution. So there are certain differences there.
And I guess there's also issues depending on what state you live in, because sometimes these treaties are recognized from a federal point of view, but some states like California, Hawaii, sadly, will treat any kind of capital gains, dividends, or interest could be taxable even if you don't take a dollar out. Do you want to comment on that that sad thing that we found out?
I should hire you, Gerry, and you don't want me to get started on the states, especially California, New York. You're absolutely right. What I mentioned relates to federal tax treatment, but states, it's completely different animal, and not all states follow federal tax treatment and comply with treaties. And California is a great example. So from the state's perspective, if you get in a situation where your claiming foreign tax credit, for example, on your federal return and end up owing no US tax, you may still owe taxes in California if you spend some time there. And that would lead to partial double taxation on the side of the state.
We did a lunch and learn with a nice accounting firm out of Toronto that works in the cross-border space out of Markham, Ontario. And this thing came up during the presentation, and we can't tell people enough that have a plan before you land, because you will be surprised. Okay, so let's get into the FBAR reporting, and how important is it for an American to file an FBAR if they are outside of the United States?
It's critical, and U.S. residents in general, with an aggregate highest maximum of values or balances in their aggregate foreign non-U.S. accounts exceeding $10,000 are required to file FBAR. It's report of foreign banks and bank and financial accounts, FBAR. It's required to be filed as matter of disclosure. Primarily, it deals with anti-money laundering rules, and it is filed electronically with FinCEN, Financial Crimes Network of U.S. Department of Treasury. Now, the failure to file FBAR on time or failure to file it at all can lead to substantial penalties. And there are three thresholds in general. So for willful violations, the penalties adjusted for inflation are $165,353, or 50% of the highest maximum aggregate account value, whichever is greater. And that's for willful violations, when the taxpayer knew about the law and intentionally disregarded the law. So that's the most horrific penalty. There also could be criminal prosecution or referral for criminal investigation. The penalties for failure to file FBAR are draconian in general for willful violations, but the penalties for non-willful violations, where you think that the IRS would give a slack to taxpayers, are still substantial. It's $10,000 per year, and just a few years ago, the question as to on which basis penalties apply was resolved in favor of the taxpayers, because before the IRS was arguing the penalties should apply on a per violation, per account basis. So you can imagine people may have 10 accounts, and if they fail to file or fail to file timely, they will be assessed $10,000 per each account. So that was really extensive. Now there is a third threshold where no penalties apply, and that happens when taxpayers are able to show what is known as reasonable cause, but it's very high standard, very difficult to meet, and the ignorance of the law alone does not suffice to meet that standard. So as a result, very limited exemption, not many taxpayers would qualify. But the taxpayers can also qualify if they are eligible for certain IRS amnesty programs. And the IRS currently has several amnesty programs, one of which allows taxpayers to become compliant penalty-free, assuming and provided they have non-willful conduct in failure to file or failure to file FBARs timely. And the current program is called IRS Streamlined Filing Compliance Procedures. It is still in existence. I would recommend and strongly advise any delinquent taxpayers to review their options, consult with their qualified U.S. tax advisor, and if they are non-compliant, review the alternatives to become compliant and become compliant as soon as possible. Because while now the program is in existence, they can become compliant penalty-free. We never know whether the IRS may change the terms of the program or may close the program anytime. So right now is the time to do it.
There's so many things that it would be fearful for those, either a Canadian going down south or an American coming up to Canada here. And if you don't know the rules, boy, it can be very stressful. Now, is there anywhere in the U.S.-Canada tax treaty that could exempt a U.S. person from filing, living in Canada, filing U.S. tax returns?
Unfortunately, no.
Okay, here's the next question. If I'm below a certain income threshold, am I exempt from filing U.S. taxes?
You may be, And technically, if you have income that equals or is below standard deduction, which for 2024 tax year is $14,600 US, for 2025 tax year it's $15,000 for single individuals who married filing separately. For married filing jointly, taxpayers, that amount is double. Then technically you wouldn't owe any tax, and so you're not required to file your tax return. However, this is true in a domestic tax context. As soon as you have cross-border connection, that answer may change. And it really depends on several factors. For example, in addition to filing tax return, you may have a requirement to attach to the return certain international information forms, such as Form 5471. And while you may not have taken any income from your Canadian corporation, you still have a filing requirement to report the ownership in your Canadian corporation to the extent that you are considered the U.S. shareholder. And failure to file that form on time would lead to a $10,000 penalty per form. So again, very significant penalties, and there are additional considerations other than the amount of income you're making when you need to determine whether or not you are required to file a tax return. And so my best advice and the best strategy would be to consult a qualified U.S. tax advisor, because that would save you a lot of headache and a lot of trap for the unwary.
You know, we're hearing about how many penalties they are and how extreme these penalties are for an American who doesn't file with the IRS. Is this consistent on the Canadian side? Because I've never heard of, I guess I filed tax returns, so I've never been in that market where there's issues. But does Canada issue large penalties as well for Canadians that don't file tax returns in Canada?
There are a lot of differences between Canada and the U.S. in terms of penalties. Canada Revenue Agency also can impose penalties, for example, for failure to file Form T1135 for an income verification statement. But the penalty is $2,500 per year, for example. Compare it with FBAR penalties I mentioned, or penalties for failure to file Form 8938, so-called FATCA form, which is $10,000 penalty, right, per form. So it's disproportional in terms of the penalties. At the same time, let's suppose that you have a business in Canada, business is losing money, you're not making any money, you're not taking any distributions from your company. If you didn't file the tax return for the company and you filed it later, since there's no tax owing, there's no income, not a big deal. But if you do the same with a U.S. company, that may lead to substantial penalties. Let's suppose that you own a Canadian company that has a U.S. subsidiary, and the U.S. subsidiary was incorporated but has pretty much no activities. There may be a requirement to file Form 5472, and the penalty for failure to file that form, or penalty for failure to file that form on time, is $25,000 US. So again, very disproportionate, significant difference. And that's where I think a lot of Canadians may think that by not filing a return in the US, it's not a big deal because, well, they can just do it later once they start making money. But that's a huge misconception. And that's actually one of the scenarios which we deal with a lot when we assist clients to request penalty abatement, because they either failed to file or they had an advisor who unfortunately missed it and did not advise them properly. And it's so simple and creates such huge penalties that I really hope that our listeners don't, try to chip out on getting qualified advice.
You know, as I think about, I'm a fan of podcasts and I listen to a lot of comedy podcasts, and I always, if you see the video on it, they're always smiling and laughing. We don't get to do that on these types of podcasts when we're talking about U.S. tax, Canadian tax. So I do apologize. But here's another thing that we've seen, and I don't know how often you come across it. What happens if a U.S. person who's living in Canada accidentally doesn't know the rules, tries to make a contribution into his IRA? Do you see that a lot?
Once in a while, occasionally. And I think for the most part, the US citizen who lives in Canada can technically contribute to their IRA account, for example, in the US. However, whether or not they may be eligible for a deduction on the US side depends on whether they have earned income. Let's suppose that they claimed foreign earned income exclusion on Form 2555, which removes all earned income on their tax return. In that case, they simply don't have an eligible earned income, and their contribution would be a failure. Now, let's suppose that they made the contribution, they qualify, but that contribution, while deductible for US tax purposes, let's suppose a US citizen is working for a US-based employer but lives in Canada. That happens, right? And there is 401k plan, and the employer makes a contribution, and the employee makes a contribution to the plan. While deductible on W-2 in the US, on the income statement in the US, it may not be and it won't be deductible on the Canadian return, right? Because Canada Revenue Agency would not allow the deduction. So you would need to back it out and add it to your income. And one mistake that people sometimes do is they take W-2, the wage and income statement, they report everything consistent with W-2, and they also do not consider that deduction they've taken, and they need to add it back on the 81. And that sometimes leads to several issues. And in many cases now, the CRA is spotting these areas because the taxpayers claim foreign tax credit, and that's when things, become interesting.
I've got a few other questions on the list here, but I think we pretty well answered everything. But I just want to get into more about some of your views and some of your clients that are talking to you, and how are they preparing when we've got this administration in the States and they're talking about tariffs and what kind of advice can you give these clients that do a lot of cross-border business, or they must be worried?
Yeah, I mean, unfortunately, there's not much level of detail available. And it looks like, certainly we need to monitor the developments and see what's going to happen. I think any tariffs are going to lead to raised prices, right? And whether it's for particular goods or for all goods, whether there would be any exemptions, that's something that we need to look into. I also think that in these situations, the clients may use or take advantage of their US subsidiaries. For example, if the client has a Canadian operation, they may consider incorporating a US subsidiary and having a split manufacturing or maybe a split activities with respect to US customers from their US base and to Canadian customers within the Canadian base. So that could be one of the strategies to help alleviate the impact of tariffs. But if tariffs are imposed, then it's going to affect everybody, and we all will see, impact financially.
We tell our people on the wealth management side, been in the business for 35 years, and we've seen a lot of things happen. May it be a pandemic, a mortgage crisis. We always tell people, be careful where you get your information. I know CNN and Fox are very loud.
Absolutely.
And we tell people that, if you can, avoid it. Be careful with your social media when you're reading stories, because a lot of clients just like to read the bold print. We've got some great sources. We've got a full-time Washington correspondent named Ed Mills out of Washington. That information has been very interesting to get, not just during times like this when there's uncertainty, but they've done a great job really keeping us up to date. And that's where we've tried to relay a lot of this information. It is a interesting time. And I've always believed that what I learned from 2007 is that good people come together and try and solve these problems. And it's out of our control. But just make sure that you're managing your assets properly. They may be short-term, medium-term, or long-term. Try not to speculate too much on markets like this. Well, Alexey, I'm going to tell you, I've enjoyed our conversation, and Mike and I, the producer, are going to do whatever we can to beg to get down to Tampa Bay one day and have a couple of beers on the down by the marina. we have spent time in Tampa Bay. It's a beautiful city, so good for you. But truly appreciate what you do for our clients, and we enjoy working with you. So thank you very much for your time.
Thank you. And by the way, Gerry, just one addition. We developed decision-making tree and flow charts. It's also going to be an article. It will be published. But if anybody is interested in receiving it, they can reach out. It will go through the whole process of determination of U.S. tax residency for Canadians and non-residents of U.S. So it's very comprehensive resource.
Well, I look forward to it. Feel free to pass that on to myself. And like I say, this podcast was intended to get people that need help, connect them with the right professionals. And Alexey is one of those guys. So thank you again for your time, and enjoy the rest of your day in Tampa Bay.
Thank you.
Thank you again for listening to the Snowbird Expat Radio Podcast. The best way you can support the podcast is to forward the episode to a friend, and please don't hesitate to like, subscribe, or leave a comment. Now, before you go, let me leave you with one of my favorite quotes. Be kind to all, the world is small.